Right now, Robinhood stock is sitting 52% below its all-time high. And if you search HUD stock today, you'll find exactly what you'd expect. Meme stock sell-off, crypto revenue collapse, missed earnings. That is the story everyone is telling. Here's what that story is missing. The underlying business just reported $307 billion in platform assets, record gold subscriber growth, $1.9 billion in net income last year. 28 Wall Street analysts have buy ratings on this stock. Their average price target is $108. That is 46% above where it trades today. ARK Invest bought $39 million in shares the day after the sell-off, and the U.S. Treasury just selected Robinhood as the sole broker for 60 million American children's first investment accounts. So which is it? A dead meme stock at a 52% discount? Or a maturing financial institution the market is still pricing like it's 2021? That's exactly what we're going to find out today. I don't own Hood right now. All of my capital is committed to another position. But if I had the capital to deploy today, Hood is one of the first stocks I'd look at. By the end of this video, you're going to know the full thesis, the super app Robinhood is actually building, and why it's nothing like what most people think. The numbers behind the bull case, the honest bear case, including the one metric management is quietly bearing. 3 major catalysts that haven't hit the numbers yet, and exactly how I'd enter this position if I pulled the trigger today. But first, we need to talk about why most retail investors have this stock completely wrong. Ask 10 people what Robinhood is, and you'll get the same answer. It's the app that gamified trading during COVID. The one that let you buy GameStop with a confetti drop. The meme stock app. Here's the problem with that story. It's about a company that stopped existing in 2021. The Robinhood running today has a $307 billion balance sheet. It generated $1.9 billion in net income last year. It has 4.3 million people paying monthly for a subscription product. It runs its own banking service, its own credit card, its own retirement accounts, its own advisory platform, its own prediction markets exchange. That is not a meme stock app. That is a financial institution. And because the headline story is still 52% below its high, institutional analysts have price targets of $108 to $130, while retail investors are writing it off entirely. That gap between what this company actually is and what the market believes it is, that's exactly where opportunities live. The question is whether the data supports crossing that gap. Let's find out. Let's walk through what Robinhood is today, product by product, because when you see it laid out, something clicks. It started as a brokerage, free stock trading. That's it. Then options, then crypto, then gold, $5 a month for margin access and premium research. Then a 3% IRA match, the best in the industry. Then banking, checking, savings, debit card. Then the gold card, a credit card with 3% cash back. The rewards go directly back into your brokerage account. Then advisory, actively managed portfolios. Then prediction markets. And now Trump accounts, investment accounts for 60 million American children with Robinhood as the sole broker. Here's the analogy that makes this click. You know how once you're fully in the Apple ecosystem, switching to Android feels like a project? That's exactly what Robinhood is building. Your paycheck lands there, your IRA match is there, your credit card rewards go there. Leaving means rebuilding your entire financial life from scratch. That's not loyalty, that's architecture. And here's the proof it's actually working. 40% of all new Robinhood customers immediately upgrade to Gold, first interaction, without anyone pushing them to. 40%, first interaction, without a sales push. Gold subscribers just hit 4.3 million, up 36% year over year, a record. Here's how the flywheel actually works. Imagine a gym membership that gives you money back on your retirement account every year, but only if you don't cancel for 12 straight months, and only if the money stays in for 5 years. That's Gold. It's engineered to make canceling feel like leaving money on the table, and 4.3 million people are voluntarily wearing that handcuff. That flywheel is why platform assets hit $307 billion, growing 39% year over year, with $18 billion in net deposits in a single quarter alone. The CFO described that quarter as one with government shutdown, software sell-off, and global conflict. The money kept coming in anyway. That's not a trading app. That's a financial institution with durable inflows. Let me give you the numbers most people dismissing this stock haven't actually read. In full year 2025, Robinhood generated $4.5 billion in revenue, up 52% year over year, net income $1.9 billion, free cash flow $1.6 billion. The company bought back $1.2 billion of its own stock at an average price of $46 per share. It's now sitting on $5 billion in cash. And then there's the macro thesis I can't stop thinking about. On the Q1 earnings call, Vlad Tenev said, and I want to quote him directly here, "We are in the early innings of the $84 trillion great wealth transfer." That is not marketing language. The biggest generational shift in financial history is happening right now. Baby boomers passing their wealth to millennials and Gen Z over the next 20 to 30 years. And Robinhood already owns the account for that entire generation. Not Schwab, not Fidelity, Robinhood. Think about it this way. Imagine you could have owned the mortgage company right before baby boomers started needing mortgages. That's the setup right now. The money hasn't arrived yet, but Robinhood already has the relationship. The bull case in one sentence: the business is already profitable and growing fast, and the biggest driver hasn't even hit the numbers yet. If you're finding this breakdown useful, hit subscribe. I break down stocks like this every single week. Real data, real thesis, no hype. Alright, back to it. Here's where I'm going to be honest with you, because the bear case is real, and you need to hear it before you build a position. Problem number 1, crypto dependency. Robinhood's Q1 2026 earnings miss wasn't a mystery. Crypto revenue fell 47% year over year. And here's the detail that should make you pay attention. On the Q1 2026 earnings call, management walked through their April trading update. Equities, strong. Options, solid. Prediction markets, record volumes. Crypto, not mentioned. Not once. It took a Compass Point analyst to directly ask in the Q&A, and the CFO's answer was, quote, "More of the same, about similar to what it was in Q1. That's management bearing a metric they used to lead with. When a company stops talking about a number they used to celebrate, pay attention." Problem number 2, valuation. At 42 times trailing earnings, Hood is priced for continued aggressive growth. If crypto stays weak and the retail trading cycle stalls, that multiple compresses, and $74 doesn't feel cheap anymore. Problem number 3, the core customer. Robinhood's average account balance is around $4,000. Average income under $50,000. When rent is high and wages are stagnant, trading volumes fall, people can't afford to put money in. That's the real bear case. Not that HUD is a meme stock, but that 42 times earnings priced for growth could hurt fast if the trading cycle stalls and crypto doesn't recover. So given all of that, why is it down 52% right now? The stock was at $60 to $70 in mid-2025. It ran all the way to $153 on momentum. Then Q1 earnings dropped April 28th with a revenue miss. The actual number came in $65 million short of consensus. The stock dropped 13% in a single day. Here's the thing though. The company is objectively better now than it was at $65. More gold subscribers, more platform assets, more product lines, profitable. The current $74 price is essentially a reset to where the stock was before the bull run, except the underlying business grew significantly during that entire period. The miss was real. The sell-off was real. But the story the sell-off is telling, that this is a broken company, is not accurate. Here's what I'd show any skeptic right now. 3 massive catalysts, none of them reflected in any reported earnings number yet. Catalyst 1, PDT rule elimination. June 4th, 2026. The pattern day trader rule required $25,000 to actively day trade. That rule is gone. 25% of Robinhood's 27.4 million funded accounts were previously restricted by it. That's direct volume uplift, and it hasn't shown up in a single reported number. Catalyst 2, the Rothera exchange launch. Robinhood built their own prediction market exchange with Susquehanna, end-to-end control of pricing instead of routing through a third party. Prediction market revenue was already up 320% year over year in Q1. Now they own the infrastructure. The margin expansion hasn't happened yet. Catalyst 3, Trump accounts. 60 million eligible American children, 5.5 million already signed up. Robinhood's sole broker and trustee. $1,000 seed per child. Funding starts July 4th, 2026. The long-term value of owning the first investment account for 60 million future investors is enormous. 3 catalysts, 0 of them in the reported numbers. The stock is trading on Q1 data before any of this has happened. Here's exactly how I'd approach this. And I want to be real with you about my own situation first. I don't own Hood right now. All of my capital is committed to another position. But if I had money to deploy today, here's exactly what I'd do. I'd buy shares and hold, long term. The thesis is 20 to 30 years of the great wealth transfer. I want to own the stock, not just collect premium around the edges. For covered calls, 4 rank is sitting at 12 to 26% right now after the post-earnings crush. Premiums are subdued. The $76 strike at 30 days out was paying about $3.88 in premium. That's roughly a 5.1% yield. Solid income. But here's my honest take. I would wait until the stock recovers toward $100 before selling covered calls against it. At $100, you're locking in cost basis reduction at a great level. And you're still giving the stock room to push toward $120 or higher, which I believe it does. This is the kind of stock I think about building around. Not a quick trade, a long-term ownership stake. And a company positioning to be the financial institution for an entire generation. Sitting right now at one of the most interesting entry points of the last 2 years. The risk is real. Know what you own. Understand the crypto dependency, understand the valuation at 42 times earnings. Do your own research, but the gap between what this company actually is and what the market is pricing it as, that's the thesis. And it's exactly why it's the least risky stock I love right now. Now that you've got the full Hood thesis, here's the next video you need to watch. The wheel strategy is exactly how I'd turn a long stock position like Hood into consistent monthly income. Covered calls, cash secured puts, rolling for credit. I will be going over the wheel strategy more in depth in a later video.